Assalamu alaikum everyone. This is my channel Tutorials on Business Education, and in this channel we'll be studying about some business related books, and the first book is that we are targeting here is Fundamentals of Financial Management. Here is the book Fundamentals of Financial Management, that is 10th edition, that is written by Brigham and Houston, and in this the first chapter that we are targeting here is an overview of financial management. But before that, students, what they will learn from this chapter, an overview of financial management. They will understand financial management in real world. They will identify forces affect financial management. They will understand the importance of finance in organization. They will know the goals of firms, and also they will understand about the contribution of financial management in goals attainment. So here, before coming to the next slide, we will first see that what is financial management. Financial management is a strategic practice that is made by the firm, and with this systematic process, they make plans, they organize, direct, and control financial activities. So here, after studying finance as a financial analyst and those who are specialized in finance, they are able to work in different areas. That is money and capital market, investments, and financial management or business finance. So here, what is money and capital markets? A capital market is an exchange where stocks and bonds are traded, and these stocks and bonds are traded so that companies are able to raise capital in order to invest in the projects in order to finance their financial activities. Now here's some of the financial institutions. They help companies to finance their projects effectively. These financial institutions are banks, insurance companies, and financial intermediary firms. Now, we will study about financial intermediaries in detail in subsequent chapters. But first of all, I'm telling you about here what is insurance companies. They provide risk protection by collecting premium to cover potential losses. And what are mutual funds? They pull up money from investors to purchase a diversified portfolio of stocks, bonds, and other securities. So, mutual fund means that these financial institutions, they sum up money and they invest those money to make a diversified portfolio. A diversified portfolio means a collection of stocks and bonds, and that try to reduce the risk. So company, they invest in diversified portfolio in order to reduce the risk, to minimize risk. Then we have investment banking firms. They act as an intermediary between corporation and investors and helping companies raise capital by underwriting or issuing securities. So before that, making an investment, they will first know what are the valuation techniques that help companies to identify a valuable project, a valuable assets, or a valuable companies in which they will make investment, and that will help them to attain their long-term objective. So these valuation companies are techniques are this is the we will study in the chapter because and here I'm only giving a brief information about valuation technique. It's a method that is used by the company to identify the value of an asset or a project or a company, and these methods help investors and businesses to decide if an asset is fairly priced, overvalued, or underrated. It means that before making an investment, they will first see whether this project is effective, whether this company where we will do with whom we are merging, or we do merger and acquisition. So is this company beneficial for us? Is this project effective for us? Will this project help us in achieving our long-term goal? So these all are determined with the help of valuation technique. Then investment here, finance managers, those who are specialized in finance, they work in the brokerage house, they as a broker, as an agent between for and they work for a company and investors. They work in the banks and insurance companies and other financial institutions. They also work in financial consulting firms. Financial consulting firms are those firms that help companies that how to raise a capital. they help companies that how to raise the capital with the help of a stock and bond. And they also provide some guidelines that how banks help businesses to raise capital. And they help their companies to do capital budgeting, to make an optimal capital structure. And then we have a now financial planners, they make long-term financial goals and portfolios, and analyzing sales and purchase. So in investments, financial analysts and financial managers, they have three main objectives: is to first analyze sales of the securities, and then they analyze the how much sales are done. The first is how much sales are done, and the second is analyzing individual security, whether this security has a good outcome. And then they evaluate the optimal mix of securities.